Hello everyone, and welcome to another edition of IronFX Viewpoint. I'm Marshall Giller, head of Global FX Strategy here at IronFX. Over the past few shows, I've shown you what analysts are expecting for currencies in 2014. Now, I'd like to discuss specific currencies, starting with the most widely traded currency pair, euro-dollar. This graph shows a summary of the 85 forecasts collected by Bloomberg News. The blue line is the highest forecast for each quarter, the green line is the lowest forecast for each quarter, and the red line is the median forecast for each quarter. That's what's usually referred to as the consensus forecast. I heard a great line recently. A consensus is something that everyone agrees to say collectively that no one believes individually. So what I'd like to do today is not just to discuss the consensus, but rather to analyze the views of the highest and lowest forecasts, because those are the forecasts that someone actually does believe. I'll then tell you what I think. The highest forecast, the firm that sees euro-dollar at 142 by year-end, is Australia and New Zealand Bank. It just so happens that a former colleague of mine is the head of research there. So I sent him a message and asked him why they thought the euro was going to be so strong. He explained it as follows. 1. Strong trade surplus. Now, it's absolutely true. The region's trade surplus has been rising steadily. That's the black line in this graph. And in this graph, I've broken down the trade surplus between Germany and the rest of Europe. So you can see it's not all just because of Germany. In fact, most of the improvement in the trade surplus is because the rest of Europe no longer has a trade deficit. You can't see it, but the latest figure here is a tiny trade surplus for the rest of Europe too. Secondly, return of capital flight. A lot of money left Europe to go into other countries, particularly Switzerland. Something like 430 billion Swiss francs poured into Switzerland as investors sought some safe haven from the crisis in Europe. The people at ANZ Bank think that as the situation in the Eurozone gets back to normal, a lot of that money will flow back into the euro. Third, underappreciation of the reform program. ANZ Bank thinks there's been a significant amount of reform, both in the individual countries that have been the source of a lot of the Eurozone's problems, and at the overall Eurozone level, such as with banking supervision. They think as the market comes to appreciate what's been accomplished, more money will flow into Eurozone assets, such as stocks and bonds, and push the currency higher. On the other hand, they're really nervous about the dollar. They argue that the U.S. still has a very wide trade deficit with the rest of the world and still has to attract a lot of capital from abroad. But that may be hard with interest rates rising. Most of the money that comes into the U.S. comes into the bond market, not the stock market. So when bond yields are rising, that means bond prices are falling. And it might be hard to attract people into the market. Plus, with short rates still at zero, that's no attraction either. So that's the bull case for eurodollar. What about the bear case? The most bearish people in the market on eurodollar are in the research department at the Dutch bank ING. They say the following. They like the dollar in general. They see structural change in the U.S. government and the U.S. economy causing the twin deficits, the government budget and the trade deficit, to narrow sharply. I've got a graph here of the twin deficits expressed as a percentage of GDP. The blue line compared with eurodollar. ING expects the twin deficits to narrow back to levels last seen in the late 1990s. The dollar was much stronger back then, as you can see. Secondly, they think this structural change will cause cyclical changes. That is, as the budget deficit shrinks and the trade deficit narrows, the Fed will be able to raise rates more quickly than the market currently anticipates. That should help the dollar across the board, too. At the same time, they think the general strength in the euro will fade for a couple of reasons. One, they think the Eurozone current account surplus will start to narrow as import demand picks up. We saw earlier how the trade deficit of all the other EU countries besides Germany had turned into a small surplus. Unfortunately, it's not because these countries' exports, the blue line, are rising. On the contrary, it's mostly because their imports, the red line, are falling. When their economies pick up, so too will imports. Please note that this is the exact opposite of one of ANZ's reasons for thinking the euro is going to appreciate. At the same time, they also expect the financial flows into Europe to slow down too. A lot of foreigners have been buying European stocks and bonds, but they think those inflows will slow. Moreover, they expect European residents to increase their purchases of foreign investments, so the net capital inflow should shrink and perhaps even turn into a net outflow. As a result, they expect the current account surplus to shrink. Finally, they're concerned that commercial banks will continue to reduce their loan portfolios this year. That's one of the main factors holding back the Eurozone economy. So, there you have it, the most bullish view and the most bearish view on Eurodollar. Which do I agree with? I go more with the bearish view. As I pointed out, the two views disagree on the outlook for the Eurozone's trade surplus. I think Europe is in a lose-lose situation. If activity picks up, then imports will pick up. If it doesn't pick up, then confidence will fall and foreign investors will start selling their European assets. Either way, I don't expect inflows into European stocks and bonds to continue at the same pace they have been, simply because they're so highly valued now. I agree that there will be some return of capital flight, especially from Switzerland, but I don't think there's really that much flight capital to go back. A lot of people who were nervous about a breakup of the Eurozone just moved their money from Greece or Spain and into Germany, rather than moving it into other currencies. That way there was no risk of losing money if the Eurozone didn't break up, which, of course, is actually what happened. Furthermore, a lot of the improvement in European risk indicators has already happened, and it hasn't helped the euro that much. This graph shows the spreads of Italian, Spanish, and Portuguese bonds over German bonds. That's a measure of how risky people think those countries' bonds are. Look at how much the spreads have come in. While they aren't back to where they were before the Eurozone crisis started in 2010, they have come down considerably. I don't know how much more they can come down. As for the underappreciation of the reform program, on the contrary, I think this year we may come to appreciate just how incomplete the reform program is. Even the European Parliament questions whether the common fund to rescue troubled banks is legal. And finally, I agree with the bull case for the dollar in general. I think the twin deficits argument is convincing, especially because the U.S. oil output is growing so rapidly. I expect the improvement in the U.S. trade picture to provide a long-term boost for the dollar. So that's my view. If you ask me where I'd be on this graph, I'd say a little below the consensus, probably midway between the red and the green lines. I expect the dollar to rise in general and the euro to weaken further. Of course, don't just listen to what I have to say. You should read a lot of information from a variety of sources, listen to what a variety of people have to say before you make up your mind how to invest. It's your money, it should be your decision. Any questions, comments? Please feel free to message me at mgitler@ironfx.com or get in touch with your IronFX representative. This is Marshall Gittler, head of Global FX Strategy at IronFX, wishing you solid trading.